Hello and greetings. My name is Dave Horning, and I would like to welcome you to this free case study created for business owners who want to learn about the business valuation process. In this presentation, you will learn about how a business valuation is prepared from both a theoretical and a practical perspective. Many of the steps required to be taken as part of the business valuation process are also used by a prospective buyer in the merger acquisition process. While these two processes are not exactly alike, there is substantial overlap. At the end of the business valuation process, you, the business owner, deserve more than just one number. That one number should not be the only deliverable. A business owner needs to know the theory and the rules of the game for both the business valuation process and the merger acquisition process, where they are the same and where they are different. You deserve more than just a number. That is what this free case study is all about. Thank you for joining. It is very important that you, the business owner, know the rules of the games so that we, working together, can break these rules. Please allow me to introduce myself. My name is Dave Horning. I live and work in Columbus, Ohio, but I am licensed to do business valuations in all 50 states. I am certified as a Certified Valuation Analyst, or CVA for short. My certification is through the National Association of Certified Valuators and Analysts, or NACVA for short. Additionally, I have an MBA in Finance and Accounting from the University of Chicago Booth School of Business. I'm also a member of the International Business Brokers Association and our state chapter, the Ohio Business Brokers Association. I work on a limited basis with certain Ohio business owners to help them sell their business in the merger acquisition process. This allows me to have practical insight into how the prices at which businesses are actually transferring in today's economic environment and how those prices compare to the theory of business valuation. I realize that most of you already know the following basics, but I want to make sure we start at the beginning so that no one is left behind. We'll be advancing rapidly into some very interesting concepts, so hang on while we cover the basics. Let's start with the definition of fair market value, which, according to the IRS, is the price that property would sell for on the open market, agreed on between a willing buyer and willing seller, neither being required to act, and both having reasonable knowledge of the relevant facts. I'm sure you've heard this before, but let's take an in-depth look at that last component. The IRS assumes that both parties have reasonable knowledge of the relevant facts. And this last point is where many business owners make the mistake preparing for their exit strategy, because when the property being sold is a business, the reasonable knowledge of the relevant facts would include knowledge of the merger acquisition process and, specifically, the market-based multiple matched with the correct level of earnings for a business of their size in their industry. A fellow colleague of mine recently told a story about a dentist who wanted to sell his dental practice. As a licensed dentist, he knew all about dentistry, and almost always more than his patients. And since dentistry is much more complicated than the process of selling a business, he assumed that he could easily learn all about the process for valuing and selling his dental practice. Unfortunately, this dentist had shut down his dental practice 2 months earlier. It was a $350,000 mistake. Now, I'm sure you're more savvy than this poor dentist, but there are still some things that are counterintuitive about valuing or selling a business. And what seems logical and intuitive to a business owner about the process of selling their business might actually be wrong and off-putting to a prospective buyer. I want you to know as much as I can teach you about both processes, because you deserve more than just a number, and I don't want you to make a costly mistake. There's another aspect of the merger acquisition process that is very important to understand. When you, as a business owner, interact with a customer, you are trying to deal fairly with that customer. Even if you could gouge or take advantage of that one customer, you would probably not do so because you have an ongoing business that depends on good word of mouth and referrals. Sadly, the merger acquisition process is usually one and done, and this means that it is difficult to get to a win-win transaction unless you, the business owner, have reasonable knowledge of the relevant facts about the merger acquisition process. I want to help you get to the yellow or green box. This next slide is my small attempt at humor, so please forgive me. I just want you to understand how aggressive the merger acquisition process can be. Perhaps the late W.C. Fields should be the patron saint of those who make a living buying businesses. W.C. Fields said, "It is morally wrong to allow a sucker to keep his money." This describes the goal of most business buyers. As a certified valuation analyst and a merger acquisition professional, it is my goal to help you understand the difference between these two processes. There are many steps that are very similar, and there are many tools and analyses that overlap. However, they are not exactly the same. A business valuation process is trying to determine the fair market value of your business. The merger acquisition process results in a transaction value, also known as a purchase price, that is hopefully satisfactory to you, the business owner and seller. These two numbers can be, but are not always the same. I would like to begin the explanation of the business valuation process with step 1, which is the reason why someone might want to do a business valuation. It is important to decide and communicate the purpose of the valuation. Here is a list of reasons why a business owner might want a business valuation. Please note that I do not practice in the field of divorce or litigation, since those types of business valuations are often used in court and require testimony, which means that there are overhead expenses which greatly increase the cost of the business valuation. I can keep my costs low and well under $5,000 because I do not do business valuations where litigation is involved. The last reason or purpose on this list is that sometimes a business owner just wants to know what drives value in his or her business, even if they have no interest in selling their business anytime soon. In addition to the purpose of the business valuation, there are many other elements or parts of the valuation that need to be decided and disclosed. I've tried here to briefly describe each element for your benefit. One of these elements is a critical element that dramatically affects the results of the business valuation and provides the reason why the business valuation process can differ so dramatically from the merger acquisition process. Stay tuned, because this will be explained very soon. The next step in the business valuation process is to plan for which methods will be used. When a valuation is done, it is customary to use at least one method from each of the three major approaches. For the asset approach, the net asset value method is almost always used. There is very little use for the book value method because it is the depreciated value of the assets on the balance sheet as of the effective date. This book value has no relationship with the fair market value of these assets. During our one-on-one strategy session, I will tell you about one key opportunity to use this method, especially if you have multiple children or heirs, and some are, but some are not working in your family business. In this situation, the book value method may be of interest to you. This graphic shows the two methods that I will be discussing in detail. For the income approach, the discounted cash flow method, and for the market approach, the comparable private transaction method, or the comparable done deals method as it is also called. I select these two methods because once the results are found and used in the business valuation, the model can also be useful for negotiating in any future merger acquisition process. Step 3 requires gathering the financial statements. As a minimum, you will need to gather 3 years of balance sheets and income statements. Most commonly, we use the IRS tax returns in a business valuation. This provides another example of how the business valuation process differs from the merger acquisition process, because as a general rule, IRS tax returns are not and should not be shared with a prospective business buyer until late in the M&A process, as a part of due diligence. Step 4 in the business valuation process starts with the asset approach and analyzes the balance sheet as of the effective date of the valuation. This net asset value method is the easiest to calculate, but there is one trick: to make sure that all of the physical assets being used by the business are on the books. Many times, a CPA will write off assets, which means to delete them from their books. Since most CPAs keep track of assets in order to determine depreciation, then if an asset is fully depreciated, there is no longer any depreciation expense and is therefore of no value to the CPA. However, it is of value to the business and to the CVA. It needs to be included in the net asset value, which is the fair market value of the assets of your company. All of the assets of your company. For both the income approach and the market approach, the first thing that we need to do is to create a representative economic benefit stream for the business. This representative economic benefit stream will be displayed as a single year pro forma income statement. Pro forma means that it is an estimate, a projection. It is intended to be truly representative of the earnings power of the business. It will be based on the last 3 to 5 years' financial performance. It will be some form of an average, either a weighted average or a true average, and it will be the appropriate level of earnings, which we will soon explain. As you can imagine, there is some flexibility in creating this representative economic benefit stream. Remember that there is a divergence between the goals of the business valuation process and the merger acquisition process. Obviously, here is an area where that divergence can take place. In the merger acquisition process, we are an advocate for the seller, so we do not have to use the same single year pro forma income statement in the merger acquisition process that we have used and set up for the business valuation process. Step 6 is to analyze and determine the add-backs, which are good for the business owner. They are also called normalizing adjustments. They increase the bottom line and thereby increase the business value when using the income and market approaches. Add-backs are expenses that are added back to an income statement's bottom line to increase profits in an effort to better represent the company's true earnings power. In the business valuation world, the add-back exercise is a sincere and legitimate effort to follow the professional standards of NACFA and create a representative economic benefit stream to show the true earnings power of the company. In the merger acquisition world, this add-back exercise is an aggressive effort to increase the profitability of the company in advocacy for the business owner as a seller. What can be considered an add-back? As I am working on your business valuation, I comb through the income statements of the past 3 to 5 years line by line to see which expenses can be considered an add-back. These add-backs can fit into one or more of the following categories listed here: unusual or unnecessary payments, abnormal or excessive payments, non-recurring expenses, also known as one-time expenses, discretionary expenses, which benefit the owner, and then there are add-backs by definition. Here are some specific examples in each category. An add-back may fit into more than one category, but will only be counted back once. An experienced CVA or merger acquisition professional earns his or her stripes by finding these add-backs. Having experience is a great advantage. If you set up a one-on-one strategy session with me, I will share with you the add-back that is most often overlooked. In step 7, we are trying to determine the correct level of earnings for your business valuation. Remember that the goal is to find a representative economic benefit stream that will be expressed as a single year pro forma income statement. A level of earnings is just a line on the income statement. So the highest level of earnings would be the top line, annual sales. Moving down the income statement, subtracting cost of goods sold, we get gross profits, so gross profits is the next level of earnings. When we subtract sales, general, and administrative expenses from gross profits, we get operating income, also known as earnings before interest and taxes, aka EBIT. If you add depreciation and amortization to EBIT, you get a level of earnings called EBITDA or EBITDA. Discretionary earnings are a level of earnings that are used for businesses that are less than $5 million in sales. Cash flow after taxes, or free cash flow, is a level of earnings used for larger merger acquisition transactions in the middle market. If you set up a one-on-one strategy session with me, I will tell you what level of earnings would be the best fit for your business. We have discussed a level of earnings called seller discretionary earnings, and I just wanted to mention here that there are a lot of other names for this concept used in different parts of the country and by different banks. There must be a dozen ways to put together the words seller, owner, cash flow, income, and discretionary. Here are a few examples. Here is an example of how seller's discretionary earnings would be calculated for a business. Note that all of the business owner's salary, benefits, and perks are added back. Charitable contributions of $27,000 are also added back. Depreciation and interest are added back by definition. Some examples of abnormal and non-recurring expenses are also added back. This example shows that the business has earnings power closer to $400,000 than the $117,000 showed for earnings before taxes. That's the whole purpose of this exercise. Please also note that banks use this type of calculation should the business owner want to borrow money for expansion, so this calculation is an important and common concept. In this slide, there is an example of a calculation of EBITDA, which is used for companies with sales in the range of $3 million to $10 million. Notice that only the excess compensation for the owner is added back. The appropriate level of earnings for this company would be EBITDA, and the EBITDA is about $918,000. The CVA determines the representative economic benefit stream by first determining the correct level of earnings, and then makes normalizing adjustments or add-backs to the past 3 to 5 years of income statements, and then uses an average or weighted average of the adjusted or normalized income statements to arrive at a single year pro forma income statement. That is considered the representative economic benefit stream. It is used as the basis for the income approach and the market approach methods. In this slide, there is an example of a calculation of cash flow after taxes, which is used for companies in the middle market. Notice that depreciation is not an add-back. For this level of earnings, the CVA must take into account the capital investment required to replace the assets that are wearing out. In other words, at this size for a company, depreciation can be a real expense. As with the last slide, we would perform this calculation for the past 3 to 5 years of income statements, and then use an average or weighted average of those adjusted or normalized income statements to arrive at a single year pro forma income statement, and use that as the basis for the income and market approach methods. We are now ready to move on to the second approach, the income approach. The two methods in the income approach are the capitalization of cash flow method and the discounted cash flow method. We're going to skip over the first method. We will use the second method, the discounted cash flow method. When we discuss the merger acquisition process, this discounted cash flow method will be used as a potential strategy for achieving more than fair market value. Stay tuned. Here is an example of how the discounted cash flow method is used to determine the value of a business. Note that we started in year 1 with a single year pro forma income statement, and then used a growth rate of 3%, which is equal to inflation, to generate the projected income statements for years 2, 3, 4, and 5. We also added the residual value of the business, and then discounted all of those future benefits to the present time by using the present value factors. We do this because a dollar in the future is worth a lesser amount than a dollar in hand today. You can see that in this example, we have calculated a business value of $1.3 million. Now, let's discuss the third and last approach, the market approach. We'll soon be done with this approach, and therefore we will be done with the business valuation process, and we will be moving on to the merger acquisition process. Stay tuned. In the market approach, there are two common methods listed here. We are going to focus on the top method, the comparable private transactions method, or comparable done deals method, as I like to call it. We are going to ignore the guideline public company method because most companies that are being valued do not have a large Wall Street public company that is similar to them. Once we have established the economic benefit stream that is representative for the business and have expressed it as a single year pro forma income statement, we need to determine the appropriate market multiple. What is the correct multiple? That is the most asked question surrounding any valuation or merger acquisition negotiation. That is why this slide is the single most important slide in the entire presentation. As you can see, there's more than one multiple. In fact, there are 5 multiples, one for each level of earnings. The key point here that is being made, you have to match the multiple with the correct level of earnings. This is vital, so let me say that again. It is critically important to match the correct multiple with the proper level of earnings. So if someone tells you what the multiple is, maybe you're at a meeting, at a convention, you need to ask them, what is this a multiple for? EBIT, EBITDA, cash flow after taxes, discretionary earnings? If someone tells you what the multiple is, they are only telling you half the story. Please note that in this slide, all 10 of the companies have the same NAICS code, 323100, for the printing industry. Finally, note that the multiple for discretionary earnings in the far right column, and note that that multiple is 3.11. We will use that in the next slide and match it with discretionary earnings. Remember this earlier slide? In it, we calculated the discretionary earnings. Let's assume that this company is a printing company, so we can use the multiples from the previous slide. Note that the discretionary earnings are $403,200. The discretionary earnings of $403,200 are multiplied by the multiple of discretionary earnings of 3.11. The product of this multiplication is the business value of $1,253,952, which, when rounded off, comes to $1.25 million. The final step in the business valuation process is to do a reconciliation of the values from the different approaches. Let's assume that the market approach provided a business value of $1.25 million. Let's assume that for this printing company that the asset approach provided a fair market value for the assets of $500,000. Let's also assume that the income approach provided a result of $1.3 million for the business value. This means that we would have 3 results for the value of the business, one for each approach. The reconciliation of values is the step where the CVA makes the final determination. It is not an average. In this case, the CVA decided to rely most heavily on the market approach, the comparable done deals method, and the CVA picked $1.25 million as the value of the business. This would be the one number that we have talked about from the beginning. But you deserve more than just this one number. Stay tuned. Let's review. We are completed with the discussion of the business valuation process, designed to find the business value using truth and integrity. Now, let's move on to a discussion of the merger acquisition process. Let's review the elements of a business valuation. Remember this list? There is one assumption in this list that carries a huge impact on the result of the business valuation. Can you guess which element it is? If you guessed that the type of buyer being a financial buyer is the element that carries the largest impact, then you picked the correct answer. Almost all business valuations make this assumption, and the result of this assumption is that the value of the business will be the fair market value, which might limit the value and be less than you might actually be able to sell the business for in the marketplace. This is why you deserve more than just one number. If there were a strategic buyer in the marketplace for your business, then we could use the same methodology used to determine fair market value and find a strategic value for your business, a higher number. This is what business owners would like to have happen for them when they transition from the business valuation process to the merger acquisition process. There could be more than one value for your business if there are strategic buyers in the marketplace looking for your type of business. A strategic buyer is a business buyer who has some form of synergy with your company, the same customer base, the same industry, the same geography, something that allows them to generate extra profits for their own operation when they fold in the operations and customers from your company. The definition of blue sky value is the amount of value for a business in excess of fair market value. A financial buyer brings no synergy to the company after closing and will likely offer no more than fair market value. They run the business as it had previously been run. There is no blue sky value for a financial buyer. Let's look at a graphic representation of these concepts. In this graph, we see that there is a strategic value in excess of fair market value. This difference is called blue sky value, as we have just discussed. Please also note that the difference between the asset value and the fair market value also has a special name. It is called goodwill. In this slide, we show the procedure by which goodwill is calculated. Earlier, we worked with a printing company that had a fair market value of $1.25 million according to the market approach. We also assumed that the company had a net asset value of $500,000. Using those two numbers, this graph shows the calculation of goodwill as being the fair market value less the asset value, which is $750,000. Goodwill is created when the earnings power of a company creates a fair market value in excess of the asset value. Unfortunately, there are many business owners whose intuition guides them to believe that their business has goodwill because they have a list of loyal customers, an 800 number that is memorable, a strong social media following, and/or an excellent website. Too many business owners have told me that they have goodwill because of these things. Unfortunately, business buyers do not agree. In the merger acquisition process, business buyers are only willing to pay for goodwill when there is strong earnings power. They will pay for customer lists, websites, etc. only if the previous owner, the seller, has used those items to generate strong earnings power. This is an example of where the merger acquisition process is counterintuitive. If you do not understand this or disagree with this, please set up a one-on-one strategy session with me at the end of the video. On this slide, we illustrate the breakdown of values in a merger acquisition transaction. The bottom two blocks, the buyer's cash down payment and the buyer's bank loan, these are the seller's favorite. They represent cash at closing for the seller. Everything above those two bottom blocks is a deferred payment to be paid out after closing, which always makes the seller nervous, and justifiably so. Many business owners contemplating signing an engagement letter to sell their business, they have told me that they do not want to provide any seller financing. I completely understand their point of view. It is intuitive. The seller wants cash at closing and does not want any amount at risk or dependent upon the future performance of the new owner, the buyer. Unfortunately, in most cases, the bank providing the financing will require some seller financing. I have always coached my sellers to pretend to embrace the concept of seller financing, as long as it is in the range of 5% to 10% of the transaction value. Obviously, if the seller wants 50% to 100% seller financing, then this is a walk-away condition. But it is a wise seller who can pretend to embrace seller financing in the 5% to 10% range. It is a bluff on the seller's part to show the prospective buyer that the seller has every confidence that the seller financing will be paid out because the seller is confident, no problem, in the future success of the business post-closing. If the seller expresses too much concern about receiving the seller financing, they are sending a negative message to the buyer, and the buyer becomes nervous. Sellers need to pretend from the beginning that they have no problem with some seller financing. Another small piece of the transaction value is payment to the seller post-closing for a short transition period. As long as it is for a short period of time, it should be acceptable to the seller. However, if a buyer wants the seller to stick around and work beyond a 3-month training period, then those payments should be over and above the transaction value. A wise buyer will keep the seller involved to maintain good customer relations. The final piece, which is the top block, is called an earnout. This is a way for the seller to participate in the future success of the business when that business does very well post-closing. If the buyer retains sales and hits certain target levels for profits, which should be based on gross profits, then the buyer agrees to pay out extra money to the seller. The earnout is often used as a bridge in negotiations when the buyer and the seller are far apart. The buyer gets the price at closing that they want, but the seller gets the funds they want after closing, contingent upon the future success of the business. The bottom 4 blocks are usually part of the transaction value or purchase price. The top 2 blocks are contingent payments. They depend upon the future success of the business. This slide shows what every seller really wants: to sell their business at a purchase price that is in excess of the fair market value and have all the money be paid at closing. This is what every seller really wants, but it hardly ever really happens. This chart shows the typical, common, or average result of a merger acquisition transaction. The seller receives fair market value for their business and provides some deferred payments for the buyer. The buyer makes a significant cash down payment and signs up for a bank loan, which the buyer will personally guarantee. A seller who has negotiated an average deal can enhance it by adding an earnout and/or an employment contract. This allows the seller to receive money over and above the fair market value for their business. The use of an earnout to pick up some blue sky value is the easiest way for the seller to monetize the future success of the business. This is a great transaction for the seller. The seller receives a transaction value or purchase price that includes blue sky value and offers just 5% seller financing. The cash at closing received by the seller exceeds the fair market value of the business. This should be the goal of every seller. This is a bad deal for the seller. They received less than fair market value for their business, even if the seller financing is paid off. Note how large the seller financing block is on the chart on the right. The purpose of this graphic is to show the seller the importance of having a business valuation performed. The business owner and future seller needs to know the fair market value of their business so they can walk away from an offer like this. Now that we have learned the rules of the business valuation process and the merger acquisition process, let's see if we can break them as Picasso encourages us to do. The most common way to achieve a transaction value in excess of fair market value is to find a strategic buyer for your business. There will not be a strategic buyer for every business, but it should be investigated. Please remember that the business valuation process assumes a financial buyer, and the result of the business valuation is a fair market value number. This is the assumption that most business owners don't understand about the business valuation process. You deserve to know that fair market value number, but also what the prospects are for finding a strategic buyer. If you hire me to do your business valuation, I will give you this information, because you deserve more than just one number. As we have already discussed, a strategic buyer is capable of paying a premium over and above the fair market value for your business because they will earn extra profits from your customer base most likely. And this is most likely because they will also sell their products to your customer base. This is something that a financial buyer cannot do. Another key point is that a strategic buyer is able to qualify for bank financing at a higher amount because they are using the profitability of their existing company with the new acquisition to qualify for that loan. Here is an example of how a seller would want to negotiate with a strategic buyer. In this case, the strategic buyer is a competitor who already has a business operation in place and can eliminate duplicate or redundant expenses. By eliminating $120,000 in expenses post-closing, this strategic buyer is able to increase the bottom line, and they are willing to pay a strategic value for your business. The transaction value was increased 30% by eliminating just 15% of the operating expenses. Another strategy for achieving blue sky value uses the income approach discounted cash flow method. This was the original analysis, which assumed 3% top-line growth in sales each year for the next 5 years. As a result of this analysis, the fair market value of $1.3 million was shown for the business. In this slide, we show the effect on value if we assume that the growth rate for the annual sales is 10% each year for the next 5 years. The business value is increased by $200,000 to $1.5 million, or 15%. If the seller can find the right buyer who can achieve this increase, or plant a vision that sales are going to be increasing at a rapid rate for some reasonable reason, then this can be very persuasive. Even if this strategy does not result in an increased transaction value, it could be valuable as it could lead to the inclusion of an earnout. It is very important that a business owner understand how cash is handled in the merger acquisition process. The amount of cash in the cash accounts is not considered part of the enterprise value. We assume that the seller will be keeping any cash in their bank accounts, and that the new buyer will open their own new bank account and make an initial deposit for reserves. However, some sophisticated business buyers are writing up their purchase agreements to allow them to grab all or part of this cash after closing. It is very important that the seller be aware of these efforts and negotiate the terms of the transaction to cover this issue fairly for the seller. If you schedule a one-on-one strategy session with me, I will cover this issue in more detail. So why is it that some companies sell easily and quickly while others struggle to find a buyer? Why are some business owners lucky in their exit strategy? The reason that some business owners are lucky is most likely that these business owners are prepared. About 2,000 years ago, a Greek philosopher known as Seneca was the first to coin the phrase, "Luck is preparation meeting opportunity." I firmly believe that business owners who get prepared, who understand the business valuation process and the merger acquisition process, they will have a very strong advantage in helping their business sell easily and quickly. I want to help you crack the code for a successful exit strategy. Together, we will determine the fair market value of your company, determine if there are any strategic buyers, and set up a winning game plan. Once you understand these important concepts, you will unlock your potential for achieving the highest transaction value for your business when it is time for you to exit. Soon, I will be inviting you to make an appointment for a one-on-one strategy session. Who is this for? If you are a business owner, either a sole owner or a minority owner, then this one-on-one strategy session is for you. If you want more than just one number as the end result of your business valuation, then this one-on-one strategy session is for you. If you want to get lucky, this one-on-one strategy session is for you. A relatively new strategy for business buyers is known as the ROBS process, or Rollover for Business Startups process. It allows prospective buyers to tap into their personal 401k funds to acquire your business without any taxes or penalties. This is a great strategy for business buyers, and business owners need to know about it also, because it takes the buyer a few months to set this up, so it cannot be explained to the business buyer the week before closing. Think about how this will help you identify serious buyers. I am offering you, at no charge, a personal and custom-tailored one-on-one strategy session. We will work to figure out what you want and how to make it happen, when you want it to happen. Get lucky. Get prepared. Time is a factor, and this opportunity will not always be open. If I am traveling or negotiating on behalf of a business owner, I often shut down the opportunity to sign up for these sessions until my schedule opens up again. To schedule a one-on-one strategy session, please click on the green bar below and apply now to see if you qualify. I look forward to talking with you soon. Thank you very much.